On September 18, 1873, the most respected banker in America walked into his office in Philadelphia and shut the doors. J. Cook had personally financed the Union Army during the Civil War. His firm had sold more government bonds than any other house in the country. He was, by every reasonable measure, too important to fail. What broke him was a railroad. Specifically, the Northern Pacific, a transcontinental line his firm had bet everything on. The railroad had been issuing long-dated bonds against track that hadn't been laid yet, secured by land grants worth less than the bonds were sold for. When buyers stopped showing up, the firm had no way to make payroll on a Thursday morning in September. By the end of that week, the New York Stock Exchange had closed for 10 days. Within a year, 90 American railroads had gone bankrupt, and the United States had entered what economic historians now call the Long Depression. In April of this year, an American company called CoreWeave reported $21 billion in debt. The debt is secured against Nvidia GPUs that lose roughly 30% of their value every year. The company pays an average interest rate of 11%. Roughly a quarter of every dollar CoreWeave earns goes straight to servicing that debt. The company has never posted an annual profit. Its largest customer is OpenAI, a company that does not yet make money either. These two stories are 152 years apart. The financial structure underneath them is almost identical. And the people who study this for a living, economic historians, infrastructure analysts, the credit desks at the major banks, are quietly making the same comparison. This is about what they're seeing, and about who, in the wreckage of the last comparison, ended up owning the country. Between 1860 and 1880, the United States added more than 75,000 miles of railroad track. At the peak of the boom, the industry was consuming close to 6% of American GDP every year. Half of that money came from European bondholders who had never seen the track they were financing. The historian Richard White, who wrote the definitive history of the transcontinentals, described the period as a vast machinery of speculative finance built on top of physical construction. The railroads were issuing more bonds than their projected revenues could ever service. The bonds were being sold on the strength of land grants whose value depended on the railroads succeeding. The whole system could only stand if everyone agreed to keep building. In 2025, the 5 largest American technology companies issued $121 billion in bonds to fund AI infrastructure, a level of debt issuance, according to Bank of America, far above any historical norm. Oracle alone sold $18 billion in bonds in a single day on September 25th. The offering was 4 times oversubscribed. 7 weeks later, Oracle came back to the bond market and borrowed another $38 billion. The investors who had bought the September bonds discovered they were holding paper they hadn't priced correctly. By December, Oracle's credit default swaps, the cost of insuring against the company's default, had climbed to levels last seen in 2009. By January, Oracle's bondholders had filed suit, alleging the company concealed how much it intended to borrow. This is the part that complicates the bubble comparison. The hyperscalers at the top, Microsoft, Google, Amazon, Meta, are paying for most of their infrastructure with their own cash flow. They are not J. Cook. But underneath them, a second financial layer is forming, and that layer looks much more familiar. CoreWeave is the cleanest example. The company rents Nvidia GPUs to AI labs that don't want to build their own data centers. To buy those GPUs, CoreWeave has borrowed $21 billion against the GPUs themselves as collateral. The loans charge an average of 11% interest. The company is paying about 25 cents of every revenue dollar just to keep up with that interest, before any other expense. In 1872, Northern Pacific was issuing 30-year bonds against railroad ties that hadn't been laid yet, in territory that hadn't been settled yet. The maturity mismatch was the whole problem. The debt outlived the assumptions. CoreWeave is doing the same thing on a compressed timeline. The hardware will be obsolete before the debt matures. And the debt is now expensive enough that the company needs the AI boom to keep accelerating just to stay current on interest. 3 companies, Amazon, Microsoft, and Google, control roughly 2/3 of enterprise cloud infrastructure in the United States. Every major AI lab depends on at least one of them for compute. The dependencies are layered. OpenAI runs on Microsoft and now Oracle. Anthropic runs on Amazon and Google. The smaller labs run on whoever will rent them GPUs. In the 1880s and 1890s, the same consolidation pattern played out in rail. Small railroads that had been built in the boom couldn't survive the bust. J.P. Morgan bought them, often for cents on the dollar, and assembled them into the regional monopolies that defined American transportation for the next 60 years. The process was so systematic that contemporaries gave it a name. They called it Morganization. The names will be different this time. The pattern is the one that's worth watching. A steel rail laid in 1875 is, in many cases, still in use today. The Pennsylvania Railroad's main line through Lancaster County uses bridge abutments that were poured during the Grant administration. The technology was durable in a way the financial structure around it wasn't. A high-end GPU bought in 2022 is, today, worth somewhere between 30% and 40% of its purchase price. By 2027, it will be worth less than scrap. The company that paid $30,000 for it will have written it down to almost nothing. This is the central asymmetry of the AI buildout. The financial structure is railroad-shaped. The underlying asset is not. Jay Cook's collapse didn't just hurt Jay Cook. It hurt the German farmers and Pennsylvania widows who had bought Northern Pacific bonds because Cook's name was on them. Between 1873 and 1875, an estimated 18,000 American businesses failed. By 1876, unemployment had reached 14%. The buyers of today's AI infrastructure debt aren't widows. They're pension funds, insurance companies, and private credit firms, often holding the debt in vehicles that retail investors are exposed to without realizing it. When Oracle's bondholders sued in January, they weren't a group of speculators. They were the institutions that hold the savings of ordinary Americans. The contagion path is different. The fact that there is a contagion path is not. So here is what the historical comparison actually tells us. The AI buildout is not 1873. The companies at the top are too well capitalized, the cash flow is too real, and the technology is doing things the railroads never did. Calling it a bubble in the simple sense is wrong. But the second layer, the contractors, the GPU lessors, the infrastructure debt issued against fast depreciating hardware, that layer is structurally identical to what failed in 1873. And when the correction comes, it will hit there first. Oracle's credit default swaps reaching 2009 highs in December was the bond market beginning to price exactly this risk. The thing the 1873 comparison gets exactly right is what happens after. The railroad bondholders lost their money. The track stayed in the ground. 40 years later, that track was the foundation of American industrial dominance. And the people who bought it cheap during the bust became the dynasties that ran the country. J.P. Morgan didn't build railroads. He bought them after they broke. The same question is now being asked, quietly, by by a small group of investors who are already positioning for the answer. When the AI infrastructure correction happens, what will be left in the ground? And who is buying it? The bond Jay Cook sold in 1872 is, today, a collector's item. Its face value was wiped out within 12 months of issuance. The track it was supposed to finance was eventually laid by other people with other money after Cook's firm was dismantled. That track is still carrying freight. The question for the next 2 videos in this series is what in the AI build-out will be the track, and what will be the bond?